Hello, this is Mike Swanson. You're listening to Inside Wall Street Window podcast. Well, I'm recording this on August the 27th. In a few moments, you're going to listen to a discussion I had with Jordan Roy-Byrne, who runs the website, thedailygold.com. Now, gold making a new high today. Bitcoin is down, and the stock market is up a little bit again. So this is kind of what's been going on the past couple of weeks. But what's really going on with the gold trend? Jordan is an expert on that. He's been active in these markets for years and know them very well. So let's get to that discussion right now. Well, thanks for taking the time to talk to me today, Jordan. How you been doing?
Hey, Mike, I'm great. Thanks so much for having me. How are you?
Oh, I'm doing fine. It's probably been about a year since I last spoke with you and did an interview like this, and a lot has happened. We had a year ago. It seems a long time ago, but the Treasury bonds were falling. Interest rates on the yields were going up, and then in October, the Fed pivoted, started to talk about lowering interest rates. And people were predicting all these massive rate cuts in 2024. They didn't happen yet, but the markets turned around and gold completely exploded. And then it consolidated, broke out again. Silver went to $26. And now gold's around 2,500 bucks. And I got to say, all the financial commentators I look at, read, and the experts out there, you've pretty much been on target with what's been going on and the trends of gold.
Yeah, Mike, it's really interesting. I mean, we're still kind of in a 1960s, like a mid 1960s like market. And I say that because everything has been going up together. Like it's very rare to see gold going up with the stock market. And so I use gold stocks as a proxy before for gold pre 1971. We were still on the gold standard. So in the 1960s, you had inflation started to break out the middle of the decade. There weren't a lot of inflation like investments, like there weren't things like tips or foreign currency. So gold stocks were one of the only things you could buy. Um, you know, supposedly, if you were worried about the economy and inflation, and so gold stocks had this massive breakout at the end of 1964. And so I liken that breakout to what we've seen in gold this year, because gold has broken out of a 12 or 13 year super bullish cup and handle pattern. The measured upside target is 3,000, which we are approaching. The log target is roughly 4,000. And so everything looks good for gold and silver. The one issue, though, is gold is still underperforming the stock market. It has not broken out against the stock market. And also, gold has not broken out against the 60/40 portfolio, the total return of the 60/40 portfolio. So that's something I created. And the reason that's important is because if you look back at history, when gold broke out against that portfolio, then it really began to accelerate both in real and nominal terms. So that breakout happened in 1972 and 2002. I mean, after you had the bottom in gold in nominal terms. So that to me is the real question over the next 12 months or so is, are we going to see a recession in the economy? Is the stock market going to crack and have a bear market? And I think I still am clinging to the fact that we need to see that happen. I think for gold to go to 4,000 or 5,000. It doesn't have to happen for gold to get to 3,000 because gold's close enough already. And I've been looking at the numbers. But to me, if we are going to see like a real accelerated move in gold, like we saw in the 70s over the next couple of years, I think you need a stock market downturn, either that or stagflation, which could be likely. So long story short, Mike, gold's broken out. Silver has broken out. The long-term trends are up. There's a real risk in the next couple of years that we can see runaway moves in these metals. But here and now, so I still have an issue with the strength of the stock market. We have to see that subside or reverse, I think, for gold and silver to really accelerate to the upside here.
Well, the stock market to me is kind of puzzling because yeah, the classic yield curve inverted almost 2 years ago. And when that happens, all the news was, well, this is the most accurate predictor of a recession. And then it turns out, well, it is, but that recession doesn't actually happen till the yield curve goes from being negative to positive. And that hasn't actually happened yet. But it's close to happening, very close. And, bad unemployment report could probably make it happen. But, when I look at the internals of the market, the advanced decline line just made a new high. So it's hard for me to want to bet against the stock market.
Yeah, I agree with you. I think that's really an important point because sometimes you do get strength in the market. You get like a final leg up before you get the recession coming in and the downturn. So I think that's definitely a possibility. I I don't think, I mean, of course, there's people calling for a crash all the time. I don't see a big crash coming, maybe until later in the decade. I don't think it's going to be this recession. I think it'll be the one towards the end of the decade, the next one. I think that's when you could see, 50% bear market in the S&P, and maybe that pulls down uh gold and gold stocks at that point. So here in the near term or medium term, I'm not worried about a major bear market or a crash. But that being said, Mike, it's definitely possible you could get a 20 or 30% bear market in the stock market over the next year or so. But yeah, the signal you're talking about from the yield curve, yeah, the tens and twos, it got pretty close to going above zero, and then it backed off again. So it's like we're just waiting for that to happen. We're waiting for that signal, and I think it will happen, but who knows? I mean, I can't tell you if it's going to happen in 1 month or 4 months, or 1 week or 4 months, for that matter. So yeah, it's really difficult to predict. But and I'm not that worried if we have a bear market. I don't think it's going to pull down gold and gold stocks by that much. I people are worried about another 2008, but Mike, I know in your experience, you remember the 2000s, the early 2000s, when gold and gold stocks and later silver actually went up during that recession and bear market. The same thing happened in the early to mid 70s. So I I am not I look at a bear market and a recession as a really, really big catalyst for precious metals. I'm not worried about it pulling everything down at this point. Sure, they could go down a little bit, but bigger picture, I'm not that worried about it.
Yeah, I agree with you because, in 2008, everything crashed. All right. And we did have a bear market 2 years ago where the stock market fell over 20%, the NASDAQ over 25%. And gold did fine that year. Now, what was interesting about that year is you mentioned the 60-40 portfolio, which is when people have about 60% of their money in stocks, 40% of their money in bonds. That's what a lot of brokers put people into, investment advisors in the United States. And in that year, that portfolio was a disaster because bonds went down. Bonds went down in value. Now, what's interesting to me now is that bonds are going up. Bonds are rallying, and they've been rallying since October. And that tells me that I don't think we're headed for a debt crisis, in the next 12 months, or a giant crash because of what the bonds are doing. But that next bear market after in the future years in the future that you mentioned before, that could be when that happens, possibly. But it doesn't look like it's happening now or going to happen on this next, whenever the next recession bear market is. It looks like it's just going to be a normal slowdown.
Yeah, that's a great point about the bond market. Yeah, you look at the charts of bonds, they're looking pretty bullish. Now, very big picture, bonds have moved into a secular bear market.
Right.
But you can have, as we know, you can have counter trend moves. And so the rally in bonds and rates going down, this is a counter trend move. And I mean, who knows? Maybe it could last for a year or two or 18 months before bonds start selling off again and inflation becomes a bigger problem. Now, of course, with gold and gold stocks, they tend to perform really well. And then inflation happens after that performance. So I think the performance we're seeing in gold and gold stocks here, it's definitely a warning that inflation could be coming back in the next few years.
Well, when it comes to the mining stocks, I own gold, I own silver, I own big cap mining stocks, and they're doing great. Newmont's doing great, Barrick's doing great. These stocks are doing great. But what had a big pop and now doesn't seem to be doing very much are the small cap juniors, that trade on the Vancouver Exchange and so forth. What do you think is going on with them? And do you think they'll eventually catch fire?
Yeah, it really depends on what you're looking at as far as juniors, because, and I'm actually writing about this. I'm about to publish a book, hopefully in the next month or so, about how if you're in the US like you and I, and you talk about juniors, you look at GDXJ, and there's many of those have a market cap of 1 billion. But if we're talking about Canada or Australia, when people are talking about juniors there, we're talking about penny stocks. So I think, but your question, I mean, the answer to that, to me, it really depends on the stock market cracking and having a bear market and gold breaking out against the 60/40 portfolio. Because I think when that happens or after that happens, that is a catalyst that's needed to bring a lot more capital into the precious metal sector, because now it's very limited. Like if you think about generalists, they're making money in the stock market. And so I think about what you said, Mike, you own gold and silver, you own a few large cap stocks, you might own a few regular stocks, but the average generalist, they're just trading in the stock market. Yeah, they probably own gold or they're holding gold, but they're not buying any of the stocks. So I think, that type of investor, you have to get the market to crack, and you have to get those people, even though those aren't the people that are going to buy juniors, but they will buy larger gold stocks, and that's more money coming into the sector. And eventually that'll find its way, down the food chain into, medium-sized juniors and smaller juniors. So I think right now, even though gold and precious metals have performed well, there's only a limited amount of capital that's going into the sector, buying the sector, and it's not making its way down all the way, to the lower half of the food chain. And so to me, I mean, the stock market cracking and you have a bear market, that's not necessarily immediately the best thing for a lot of juniors. They'll probably get hurt by that in the short term, but I really think you need that to happen, because on the other side of that, you have a lot more money coming into the precious metal sector, and then that's going to find its way down to the lower ends of the food chain.
Well, I wasn't really following that closely earlier this month. We're doing this in August when the VIX went up to 65 and there was a bit of panic in the stock market, and Bitcoin really has been sagging since then. It had a horrible day on that decline, but gold just gapped down a little bit and soared right back up to new highs, fast. The mining stock, same thing. But did the juniors get hit hard like Bitcoin, or did they just kind of ignore it? That decline.
I mean, yeah, it depends how hard, because I think some juniors, I mean, again, it depends what market caps you're talking about. I mean, I kind of follow, and let's just say the ones I look at, they're, 500 million, 400 million, 300, those types of market caps. And some of those stocks, they were hit like 20%. And yeah, they've started to rebound. I mean, the stronger ones have already gone back to new highs, but many of them, they've rebounded. They're still below the old highs. So yeah, they did get hit. I think juniors did get hit, but they are recovering.
Okay, well, that's good. It looks like, I don't know. I'm pretty positive between now and the end of the year on this sector. I assume you are too.
Yeah, one thing I want to mention, I've been writing about it and I talked about it in videos in the last week or two, is if you look at the charts of GDX and GDXJ, well, GDX especially, Mike, I know you know this. GDX GDX is a couple percent away from what would be like an 11-year high, I think in weekly terms. So if you're looking at GDX, it's coming up on a like a 4-year base, I think around 40 or 41. So if GDX breaks above that, that's the highest close since the end of 2012. And if you look at GDXJ, since that point, it has only traded above 47, 48 for a little while. And so if it breaks up here, it's going to be basically at a 3-year high. So if you look at GDX and GDXJ, like these are legit breakouts that they're on the cusp of. In addition to that, I mean, you're probably familiar with the TSX Venture Index, correct?
Yeah, sure.
There's another index based off of that index that only contains gold companies, only contains junior gold companies. It's called the TSX Sub Gold Junior Index. And it's a Bloomberg thing. I've posted on Twitter and in my updates. It has 28 companies in it. The median market cap is about 200 million. The average is about 340 million. And if you look at that index, Mike, that basically has a perfect 10, 11-year base. And so it still has another 15 or 20% to go until it breaks out. But if you're looking at the chart, there's this nice long base. And so to me, you get GDX breaking out first, then GDXJ. Then I think you're talking about the last part of the year, probably towards the end of the year, then you could have this junior index breaking out. So I agree with you. I think things are set up for a really, potentially explosive move in the stocks into year end.
Well, what I'm going to do, you got an article on your website, a free article you mentioned that talks about this index and has the chart in it. I'll include that in the show notes so people can click and go there. They can also subscribe to your newsletter by doing that too once they get there. I'll just say this. As far as the way gold is trading, maybe I'm reading too much. I don't know. I could be wrong when I say this, but I've been doing this since the 90s, and the action's a little similar to me as back in 2010, because gold broke out back then, and it went up slowly all year long. And not many people really paid attention to it except the gold community, because the stock market was coming alive too. But it would go up slowly and have a down day, but not really drop much, then have an up day. And so far, the past several weeks, that seems to be the way it's trading. And I just wondered, is it just going to do that for the rest of the year?
Well, I think it will, Mike, because I don't see the stock market having, again, it depends on the stock market, which is difficult to call. And now we're thinking about the economy and are we going to go into recession and the yield curve steepening? But I think if things continue with where we are now, I do think you can see gold make it to 2,900, 3,000 by not necessarily by the end of the year, but early next year. And I think the trading will be similar, because I could be wrong, but I don't see gold breaking out against the stock market yet. And maybe the stock market will continue to run for the most part alongside gold. So that's a very good point that you're making. And that goes back to my thinking that we're not going to see an accelerated move in gold until you get that crack in the economy and the stock market.
And I'll just say one last thing about that. The yield curve signal, when it goes from negative to positive, if you look at that, it does. Sometimes the recession is instantly happening, but other times it's still months out, 6, 8, 9, 10 months out. So
Yeah, and I think I mentioned that in the video. There are some historical examples of that where you do get the steepening in the yield curve above zero, but then the stock market, because the Fed starts cutting, and then that gives the stock market like a last burst before it peaks. And so who knows? I mean, that's definitely a possible scenario that the Fed will start cutting and maybe the market peaks a couple months after that. And then this is like a final burst for the market before the recession and bear market.
And they're definitely cutting. And so far, the cut talk isn't helping crypto. Maybe they'll launch new crypto ETFs to try to get more money in there, but it didn't work with the Ethereum ETF. So I don't know what'll happen with crypto anymore. It's anyway. I, it's just it's crazy. Well, thanks for taking the time to talk to me and everyone else, and highly recommend people go to thedailygold.com and subscribe.
Yeah, thank you so much, Mike.